Silver Reset. Why this critical moment matters for traders. February 4th, 2025. Silver didn't just move, it fractured. And most traders still don't understand what they just witnessed. While headlines scream about statistical impossibilities and 10 sigma events, the real story is being written in position liquidations, margin calls, and warehouse inventories that tell a very different tale. This wasn't a glitch. This was a reset. And what happens in the next 72 hours will determine who survives and who gets erased from the board entirely. Welcome to Metal and Macro. If this is your first time here, let me ask you something the way I'd ask a wise friend who's seen a few market cycles. Would you mind hitting that subscribe button? Not because everyone else is doing it, but because what we discuss here isn't available in the headlines. And if you've made it this far, you already know that matters. Now, drop a comment and tell us, where in the world are you watching this from? Because understanding silver's reset isn't just an American story or a European one. This is global, and I want to know whose portfolio is on the line right now. Let's begin. On February 3rd, 2025, silver traders woke up to a market that no longer made sense. At exactly 9:47 a.m. Eastern Time, silver futures dropped 4% in less than 6 minutes. Not gradually, not with warning, but with the kind of velocity that triggers automatic circuit breakers and forces exchanges to pause trading. The price fell from $29.70 per ounce to $28.52 before anyone could react. Volume exploded, margin calls went out, and by the time the dust settled, billions of dollars in leveraged positions had been liquidated. But here is what made this different from ordinary market volatility. This wasn't just a price drop, it was a structural fracture, the kind that reveals how fragile the entire silver market really is. Within hours, social media erupted with claims that this was a black swan event, a 10 sigma statistical impossibility, something that should only happen once every several million years. Analysts scrambled to explain what their models couldn't predict. And retail traders, many of whom had entered silver positions based on bullish momentum, watched their accounts drain in real time. But those who study market structure weren't surprised. They had seen this before. In 2011, silver crashed 30% in 5 days. In March 2020, it dropped 27% in a single week. Silver doesn't move like other assets. It doesn't respect the bell curves and probability distributions that work for stocks or bonds. It moves in violent, unpredictable bursts that punish those who don't understand its nature. So what actually caused this particular reset? The surface explanation is simple. A large institutional player, likely a hedge fund or commodity trading firm, was forced to liquidate a massive long position. And when they started selling, the market couldn't absorb the volume, liquidity vanished, bid prices collapsed, and automated trading systems, programmed to follow momentum, amplified the move downward. This is called a cascade. One forced seller triggers stop-loss orders. Those stop-losses trigger more selling. And suddenly, the entire market is in free fall. But that's only the mechanical explanation. The deeper question is why silver was vulnerable to this kind of cascade in the first place. Silver trades in two parallel markets. The paper market, where futures contracts and derivatives change hands electronically. And the physical market, where actual metal is bought, stored, and delivered. In theory, these two markets should stay aligned, but in practice, they often diverge. Dramatically, at the start of February, the paper market was showing signs of extreme leverage. Open interest in silver futures had reached levels not seen since the previous cycle peak, meaning traders were holding positions far larger than the physical silver that actually existed to back them. This created a fragile system, one where a sudden shift in sentiment or a forced liquidation could trigger a chain reaction, and that's exactly what happened. By the end of the trading day on February 3rd, silver had recovered roughly half its losses, closing at $29.11, but the damage was done, not to the price, but to confidence. Traders who had been riding the momentum higher suddenly questioned whether the rally was real, whether silver's recent strength was backed by genuine demand or simply speculative froth, and more importantly, whether another shoe was about to drop. What many failed to recognize in that moment was that volatility itself is information. Markets don't move violently without reason. The February 3rd reset wasn't random chaos. It was the system revealing where stress had been building, where leverage had accumulated, and where the next breaking points might be. The traders who understood this didn't panic. They started mapping the battlefield, identifying who was forced to sell, who had the capital to buy, and what the next move would likely be. Because in silver, resets aren't endings. They're chapter breaks. And the story was far from over. The question wasn't whether silver would stabilize. The question was what force would dominate next, and whether traders were prepared for what that force would demand. Most traders treat silver like its gold's smaller cousin, a simple precious metal that moves up when inflation fears rise and down when confidence returns. But that assumption has destroyed more portfolios than any market crash ever could. Because silver isn't just one thing, it's two completely different assets trapped in the same ticker symbol. And until a trader understands this split personality, every price move will feel random. Every volatility spike will seem like an accident, and every reset will catch them completely unprepared. Here's what makes silver different from almost everything else traded on modern exchanges. Roughly 50% of annual silver demand comes from industrial applications: solar panels, electronics, medical devices, electric vehicle components. This demand is inelastic. Manufacturers need silver to produce their goods, whether the price is $25 or $35 per ounce. They don't have a choice, but the other 50% of demand comes from investors, people buying physical bars, ETFs accumulating metal, speculators trading futures contracts. This demand is entirely emotional, driven by fear of currency debasement, geopolitical instability, or simple momentum chasing. And these two demand sources operate on completely different timelines. Industrial buyers plan quarters or years in advance. Investors react to headlines in minutes. Now layer on top of this the way silver actually trades. The physical market is small. Roughly 1 billion ounces of silver are mined globally each year. At current prices, that's about $30 billion in total annual production. For context, Apple's market capitalization is over $3 trillion, 100 times larger than the entire annual silver supply. But in the paper market, the numbers tell a very different story. On the COMEX exchange alone, daily trading volume regularly exceeds 150 million ounces. That's 15% of global annual production, trading hands, every single day. Most of it never involves physical metal. It's just contracts, promises to deliver silver at some future date. Promises that are almost never kept because both parties close their positions before delivery. This creates a strange mathematical reality. For every ounce of physical silver that exists in COMEX warehouses, there are often 30 to 50 ounces of paper claims against it. Imagine a parking garage with 100 spaces, but 3,000 parking tickets have been issued. As long as most drivers don't show up at the same time, the system works. But the moment too many people try to claim their spot simultaneously, the entire structure collapses. This is why silver resets happen. Not because of manipulation or conspiracy, but because of mathematics. When leveraged speculators pile into long positions, they're not buying silver. They're buying exposure to silver's price movement. And that exposure is created by someone on the other side of the trade, usually a commercial bank or a mining company hedging their production. These commercial players aren't making directional bets. They're managing risk. But when the market becomes too one-sided, when too many speculators are long and too few commercials are willing to take the other side, liquidity disappears, and price has to move violently enough to force positions to unwind. There's another structural element most traders miss entirely. Silver's market is concentrated. A handful of banks control the majority of the short positions on the COMEX. A small number of ETFs hold the bulk of investor silver, and just a few countries produce most of the world's supply. This concentration creates brittleness. When one large player moves, the entire market feels it. Unlike gold, where the market is deep enough to absorb billion-dollar flows without much disruption, silver's smaller size means that institutional scale trades create earthquakes. So when traders ask why silver dropped 4% in 6 minutes on February 3rd, the answer isn't found in that day's news. It's found in the structure itself, in the leverage ratios, in the concentration of positions, in the gap between paper promises and physical reality. Silver doesn't reset because it's broken. It resets because it's working exactly as designed. A high-leverage, dual-purpose asset where industrial stability and speculative mania collide constantly. And the traders who survive aren't the ones with the best predictions. They're the ones who respect the system's nature, who size their positions knowing that a 4% move in 6 minutes isn't an anomaly. It's a feature, not a bug. And the next reset is already being built. Right now, in position reports most traders will never read. Every market has players, but silver has something different. It has architects. Entities whose decisions don't just influence price, they construct the entire battlefield where price discovery happens. And in February 2025, these architects were moving pieces most traders couldn't even see. Start with the central banks. For decades, they focused almost exclusively on gold, building reserves, managing currency backing, treating precious metals as a hedge against their own monetary experiments. But something shifted in late 2024. Data from the World Silver Survey revealed that central bank interest in silver had quietly increased. Not dramatically, not enough to make headlines, but enough to signal a change in thinking. Why? Because silver sits at the intersection of two massive global trends: the energy transition and monetary instability, Solar panel production alone is projected to consume over 200 million ounces annually by 2030. And as fiat currencies face increasing pressure from debt loads and geopolitical fragmentation, silver offers what gold cannot. Industrial necessity combined with monetary optionality. This makes central banks pay attention, not publicly, but in the quiet accumulation patterns that show up months later in official reports. Then there are the commercial players, the mining companies and industrial users who hedge their exposure through futures markets. These entities aren't speculating. They're locking in prices to manage business operations, but their collective positioning creates a map. And right now, that map shows something unusual. According to the latest Commitment of Traders report, commercial short positions had reached a 5-year low just before the February reset, meaning the traditional sellers. The ones who normally provide liquidity when speculators want to buy had stepped back. They weren't willing to sell at prevailing prices, which left the market structurally vulnerable. Because when commercials reduce their shorts, it signals they expect higher prices ahead, or at minimum, they're unwilling to bet against the current trajectory. On the opposite side sit the managed money funds, hedge funds, commodity trading advisors, algorithmic systems. These players don't care about silver's intrinsic value. They care about momentum, trends, patterns that generate returns. In January 2025, managed money net long positions in silver had surged to levels not seen since 2021. They were all leaning the same direction, betting on continuation, assuming the trend would persist. But markets don't reward consensus, they punish it. And when everyone is positioned the same way, the slightest crack becomes a catastrophe. One forced seller triggers a cascade. Stop. Losses activate. Algorithms flip from buy to sell. And suddenly, the crowd that was chasing momentum higher is trampling each other, trying to exit. Beyond the visible players, there's another force most traders ignore entirely: physical market tightness. While paper traders were playing their leverage games, something else was happening in the real world. COMEX registered silver inventories, the metal actually available for delivery, had been declining steadily throughout 2024. Not collapsing, but draining. From over 80 million ounces in mid-2024 to below 50 million by early 2025. Meanwhile, premiums on physical silver coins and bars remained elevated. Dealers were struggling to source metal. Mints were reporting multi-week delays. This divergence between paper abundance and physical scarcity creates tension, the kind that eventually must resolve. Either paper prices rise to attract physical supply, or the paper market breaks entirely when too many contracts demand delivery simultaneously. And then there's the geopolitical layer. Trade tensions between major economies, currency warfare disguised as tariff policy, de-dollarization efforts by nations seeking alternatives to U.S. Treasury holdings. These macro forces don't move silver directly, but they shape the environment where silver operates. When confidence in fiat currencies erodes, when supply chains fragment along political lines, when nations stockpile strategic materials as economic weapons, silver becomes more than a trade, it becomes a necessity. So why did the reset happen in early February specifically? Because all these forces converged simultaneously. Commercial hedgers had reduced their willingness to sell, speculators had built enormous leveraged longs, physical inventories were thin, and geopolitical uncertainty was rising. The system was loaded. All it needed was a spark, one institution forced to liquidate, one margin call that couldn't be met. And the entire structure unwound in minutes. But here's what separates informed traders from the crowd. The crowd saw chaos. The informed saw transition, a market resetting to accommodate the next phase. Because the forces driving silver haven't disappeared, the energy transition still requires massive silver consumption. Monetary instability continues accelerating. Physical tightness persists beneath paper volatility. The February reset didn't end the story. It cleared out the weak hands, the over-leveraged speculators, the momentum chasers with no conviction. What remains now is a cleaner battlefield, where the next move will be determined not by who panicked, but by who understands what these forces demand next. And whether the physical market can continue supporting a paper structure built on promises that may soon be called due. Understanding what happened means nothing if it doesn't change what happens next. The traders who survive market resets aren't the ones with the best explanations. They're the ones with the best preparation. And right now, preparation means watching specific indicators that most market participants will ignore until it's too late. First indicator: COMEX, registered inventories. This is the metal actually available for immediate delivery, not the total silver sitting in warehouses, but the portion that can be claimed by contract holders. As of early February 2025, registered inventories sat near multi-year lows, below 50 million ounces. For context, a single large institutional player could theoretically claim that entire amount with less than $2 billion. That's not a lot of metal backing a market where daily paper volume exceeds $5 billion in notional value. When registered inventories decline while open interest remains elevated, the gap between promises and reality widens, and that gap eventually closes, either through price rising to attract more physical supply into the registered category, or through a delivery crisis that forces the paper market to acknowledge its limitations. Traders need to monitor this weekly, not monthly, because when registered silver drops below 40 million ounces, the probability of a supply squeeze increases exponentially. Second indicator, the spread between physical and paper prices. In normal markets, physical silver trades at a small premium to futures prices, typically 1 to 3%, covering storage, insurance, and dealer margins. But when that premium expands to 5% or more, it signals that physical buyers don't trust paper prices. They're willing to pay significantly more for actual metal than for contracts promising future delivery. This divergence appeared briefly in 2020 during the pandemic, and again in late 2022 during banking sector stress. Each time it preceded significant price moves, not immediately, but within weeks or months. Right now, premiums on retail products remain elevated, not yet at crisis levels, but trending in that direction. Traders watching this spread gain early warning of when paper and physical markets may decouple entirely. Third indicator, ETF flows. The largest silver ETFs hold over 600 million ounces collectively. When institutional money flows into these funds, it removes physical metal from the market, locking it away in vaults, reducing available supply. Conversely, when ETFs see outflows, metal returns to the market, providing liquidity. In January 2025, silver ETFs experienced modest inflows despite price volatility, suggesting that long-term holders weren't panicking, they were accumulating on weakness. But if those flows reverse, if institutional holders begin exiting, the metal flooding back into the market could pressure prices significantly. This indicator updates daily and provides real-time insight into whether smart money is buying fear or selling strength. Now, for scenario mapping, professional traders don't predict, they prepare for multiple outcomes. Base case scenario, silver consolidates between $27 and $31 through mid-2025. Volatility remains elevated but without directional conviction. Physical tightness persists but doesn't reach crisis levels. Commercial hedgers gradually rebuild short positions, providing liquidity that stabilizes the market. In this environment, traders avoid leverage, focus on physical accumulation during dips, and remain patient for the next structural shift. Bull case scenario, a supply disruption or geopolitical event triggers delivery concerns. Physical premiums spike above 10%. COMEX registered inventories fall below 35 million ounces. Short covering accelerates as commercials refuse to maintain short exposure. Price breaks above $35 and doesn't look back. In this scenario, those who accumulated physical metal during the February reset and those who sized positions conservatively enough to survive volatility capture substantial returns. But those who chase momentum after the breakout, or who over-leverage into the move, face the same liquidation risk that crushed speculators in early February. Bear case scenario, global economic slowdown reduces industrial demand. Investment flows shift away from commodities toward bonds or equities. ETFs experience sustained outflows. Registered inventories rise as metal returns to the market. Price breaks below $25, testing the 2023 lows. In this environment, only those with genuine long-term conviction survive. Those trading on momentum or leverage get destroyed. Physical holders endure drawdowns but maintain optionality for the next cycle. The critical discipline isn't choosing which scenario will happen. It's positioning so that no single scenario ruins you. This means several things practically. Position sizing matters more than entry price. A trader who buys at $28 with appropriate size can survive a drop to $24. A trader who buys at $26 with excessive leverage gets liquidated before the bottom. The reset proved this. Those who survived weren't necessarily right about direction. They were right about risk management. Physical versus paper allocation determines survivability. Paper positions offer leverage and liquidity, but they carry counterparty risk and forced liquidation potential. Physical metal offers no leverage, but it can't be margin called. Can't be liquidated by someone else's decision. The optimal allocation depends on individual risk tolerance, but the February reset demonstrated clearly paper traders need exit plans. Physical holders need patience. Correlation awareness prevents portfolio-wide disasters. Silver doesn't move in isolation. It correlates with gold, with real interest rates, with the dollar, with industrial commodities. When these correlations break, when silver moves opposite to what its usual relationships suggest, that's information, not noise. Traders who monitor correlation shifts gain early warning when market structure is changing. So what should a serious trader do now? Not what feels comfortable, but what the structure demands. Monitor the three indicators daily: registered inventories, physical premiums, ETF flows. These aren't predictions. They're the market's own stress test, revealing where pressure is building before it explodes. Size positions for volatility, not for comfort. If a 4% move in 6 minutes feels catastrophic, the position is too large. Period. Maintain liquidity. Markets reward those who have capital when everyone else is forced to sell. The February reset created opportunities, but only for those who weren't already fully deployed. Separate signal from noise. Every headline will claim to know what comes next. Most will be wrong. The signal is in the structure, in the inventories, in the flows, in the actions of those who have no choice but to act. Silver's reset wasn't an ending. It was a stress test, one that revealed who understood the game and who was just along for the ride. The next phase is already forming, in warehouse receipts, in hedger positioning, in the growing gap between what paper promises and what physical can deliver. The traders who survive what comes next won't be the ones with the best predictions. They'll be the ones who respected the structure, managed their risk, and understood that in silver, resets aren't failures. They're the system working exactly as designed, violently, efficiently, and without mercy for those unprepared.